All right, today we're digging into a technical analysis on NIO. It's trading at $5.75 after a pretty brutal 9-day losing streak.
Yeah, it's a classic buy the fear kind of setup. You can feel the tension in the chart.
You really can. But I think the execution in the analysis, it just needs a clearer recipe. So let's jump right in.
Okay, so the first thing that jumped out at me, and I think it's a big one, is about timing. You need to integrate specific fundamental risks directly into your technical risk management structure.
You're talking about the November 25th earnings report, right?
Exactly that. The write-up mentions pre-earnings anxiety and ONVO margin fears, but then the stop losses, they just sort of float there.
Right. They aren't actually connected to that hard date. So the weakness is that your stops are, they're totally independent of the very catalyst that's driving all this volatility.
Precisely. So the suggestion here is pretty straightforward. Use that catalyst date. Use November 25th to really define your risk horizon.
Okay, so a concrete example would be, instead of just setting a stop below $5.50, you'd explicitly state, this is my final out before that report hits.
Yes, or even better, you could recommend using that $6.10 bounce target as a point to de-risk completely. Get out, protect your capital before that known high-impact event happens.
That makes perfect sense. So if we anchor our risk management to that deadline, we hit the next issue. What's the actual trade? Because right now, there are 3 different plans laid out. The 3 equally weighted trade plans dilute the primary bullish message you intend to convey.
But wait a second, isn't that a good thing? To give the reader more options? You know, a long, a conservative long, a short. It makes the whole thing feel more balanced.
It feels balanced, sure. But the indicators are pointing to are not balanced at all. Your RSI down at what, 27 to 33? That's screaming for mean reversion opportunity.
Ah, okay, I see what you're saying. So the weakness is that your strongest, highest conviction signal gets kind of lost in the noise of all these other options.
It does. So our suggestion is to restructure the whole analysis, create a clear hierarchy.
And what would that look like? Give me an example.
You'd frame that aggressive long, the entry at 575, as your base case. That's the main trade, the one you actually believe in based on the signals.
Okay, so what about the short position then?
The short becomes a contingency plan. It only becomes the active trade if, let's say, NIO fails to hold that 575 support and then gets rejected at the 5-day SMA around $612. You'd establish a very clear if this, then that priority for the reader.
Got it. Creating a clear path. Which, speaking of clarity, brings me to my last point. The crucial stop levels and the $630 gap fill target rely too heavily on basic horizontal action and need more technical context.
You're talking about the $5.50 hard stop and the $5.20 structural hard deck?
Yeah, they feel a little bit asserted, not proven, like they were just picked off the chart.
And the weakness there is that the analysis mentions all this consistent selling volume, but then doesn't use volume context to actually anchor the risk. It feels like a real missed opportunity.
It is. So the suggestion is to give those hard stops some real technical muscle.
So?
Well, for that $520 hard deck, don't just call it a historical price level. You need to validate it. Show that it's a key high-density area confirmed by, say, a volume profile or an anchored VWAP from a previous significant low.
So you prove why it's a structural level.
Exactly. And also explicitly show the math for that 3-to-1 risk-to-reward ratio. Clearly connect the $630 target to the stop below 550. Make it obvious why that trade is worth taking.
All right, I think that's a good place to wrap. We have 3 really clear, actionable items here.
Yep. First up, time your exit strategy specifically to that November 25th catalyst.
Second, stop giving equal weight to all the trades. Prioritize the mean reversion long that your deep oversold indicators are clearly supporting.
And finally, use advanced context like volume profile to give those critical stop levels real structural justification.
That nails it. Make those adjustments, and we would love to see this work again.